Hello and welcome to the market update for Tuesday, July the 12th. If you have any questions during the week or any that I don't get to in the live class here, make sure you send those to Jerry at traderspro.com. Mostly, the market is mostly just waiting for tomorrow. I don't expect to see a significant move today. We've been kind of flat most of the day, up and down a little bit, but everyone's waiting for that CPI report tomorrow. The CPI report is the report on inflation, and obviously the market is obsessed with focusing on inflation, as it should. That's what's causing the movements in the market is decisions based off of rising inflation. So now it can be difficult. I don't like markets that are so focused on reports or something that we can't kind of anticipate ahead of time. What we call binary events, which means that when that event happens, either the market's going to start going up or going down, but it all depends on what that information is. It's like an earning announcement, and I've talked about this a number of times. I don't like to trade a stock right before an earning announcement because the earnings could be great and the company goes down. The earnings could be bad and the company goes up. The stock goes up. The stock could have great earnings and the stock goes up, or bad earnings and the stock goes down. There's so many different reactions to that event, that news, and it can be big. You usually get a really big move around an earning announcement. It's just impossible to know what that direction will be. And even when it appears like it should move, like I said, has good earnings, you're expecting a big move up because of that, and it goes down, it gets really confusing. Now, again, obviously the market is always gathering information. It's just that sometimes it gets focused on one event bigger than others out there, and a lot of them are centered around the Fed. Any Fed announcement is always going to have a lot of attention and a lot of focus. Like I said, these CPI reports, they really haven't. The market, obviously it follows it. There's fundamental traders that follow it all the time, but it doesn't have as big an impact on the market move as it does right now, when the market is really focused on it and really trying to anticipate what that number means. So the reason why I'm saying this is that we can analyze some of the charts, but some of those chart movements can change very quickly based on that binary event. Just like a stock, for example, and I like to use earning announcements because those happen more often. But I've had this happen before where I'm approaching this from a technical point of view. I'm a technical trader. I don't usually care too much about all the other noise. I care about what the chart or what the price action is telling me. But this is what can happen with an earning announcement, and this is why I don't like to trade it. You can have a nice uptrending stock, a nice ABC pattern, even a bullish reversal confirmation down at the bottom, which I would love to see, some sort of bullish candle right down here. The chart is screaming that stock should go up. And then you have this earning announcement that comes out. It's a binary event. You don't know what the numbers are going to be. And more importantly, you don't know what the reaction to those numbers is going to be. The company comes out with, let's say, great earnings, but their forecast is a little light or is changed a little bit, and suddenly that stock opens up down here and it gaps down. It can be very frustrating because the chart is telling you it should go up, but the reaction to that event is not only in the opposite direction, but it can be big in the opposite direction. And so a lot of times what I'll do is wait till after the earnings. If I see a stock that's a nice uptrend, has an earnings report, I'll wait till after the earnings report to make that decision to get in. But then the downside of that is maybe they do report great earnings and it gaps all the way up here. Now you feel like you're chasing it, and you're getting a late entry into those trades. So Um, the reason why I'm starting off the class this way with talking about this is one, because it's nice to discuss some things where it's not the same routine every update, to where it feels like we're talking about the same stuff. Because these are little things that you don't think to talk about or bring up in a some sort of training course, but they're things that happen all the time in the market, and you'll see it over time. The longer you're trading, you see that the market starts focusing on certain things, whether it's the Fed or sometimes it'll be. I remember a few years ago there was a bunch of stuff going on in Europe, and usually the European markets don't affect our markets. Usually they're following our markets. They're reacting to how we're trading. But this unique period of time, everyone was focused on Europe, and I remember getting up in the middle of the night to see how the European markets opened, to see how we might open that next day, and it only lasted probably about 3 or 4 months, but that it might not have been that long. It might have only been like 2 or 3 months. But that's what the market was focused on at the time, and so I kind of altered my routine. Normally, I'm not going to get up in the middle of the night to see how the European markets open, but because that's what the market was focused on at that time, that's what I had to do. So I just think it's important to point that out, because if you're a new trader and you're saying, man, CPI report, everyone's talking about the CPI report, that's got to be part of my daily routine from here on out. I got to know what that CPI number is and all that. I'm telling you right now, yes, you need to know what it is for probably the next couple of months, but after that, the market will have very little reaction to that number, and it'll be focused on something else, and you've got to pivot to whatever it's focused on next and make that part of your routine. But again, the good news is if you really just become a technical trader, you have to be aware of those things, those other events, and what the market is focused on, but it's not going to be the main thing that's driving your decisions. The chart is going to drive your decisions. All right, that said, the direction alerts, there's really not anything to talk about in the direction alerts. We know we're in a bear market. We're in the far left side here. Still trending down, not even seeing any sort of an uptick here in that trend down. The short-term indicators are, or the momentum indicators in the middle range, so it's not overbought or oversold, isn't really. It tells us that we could. What it's basically saying is we because we're in the middle here, we could really start moving up higher until we get overbought, or we could drop significantly further before we get oversold. We really could make a significant move in either direction. And these are, again, what we're looking for usually here are these extremes. We're trying to see this would be overbought, this would be oversold, and because that can pinpoint a possible reversal. If it gets oversold, there's a chance you could see a bullish reversal. If it gets overbought, you can see more of a bearish reversal. So you want to be aware of that, because that's telling you where you are in the trend. Now, so right now we know we're in a bear market, we're in a downtrend, okay? And we've kind of consolidated a little bit. We're kind of in this little consolidation phase. We'll look at the market charts here in just a second, so you know, to just see me try to draw everything out. But because we're in a downtrend, what we're assuming here is, okay, we've alleviated that oversold condition. We were in here, we came up to the middle right here, and what that tells us is that that this trend is, well, the trend is telling you it's likely to continue to go down. If it starts to go down again, and this thing moves back over here to the oversold, what this can signal right here is, okay, it gets to that extreme, and particularly if it gets to the far left side of that extreme box right there, it can tell you that downtrend that you've continued is probably getting ready for another correction or possibly a trend reversal. It could start a new uptrend from here, but you're probably getting due for a bounce or some sort of relief rally, maybe just a step within the downward stair step. So since we're still in the downtrend, what we're assuming as far as this indicator is concerned is that it'll start to move. it'll probably start to move more to that extreme, which means we're likely to see another move down at some point, and then this will become significant when we're moving down again, because it'll tell us when we need to start paying attention to a potential bounce or something like that. And again, how is that important? Well, if you're shorting stocks, which I'm not pushing in this class, we try to be long with this software. Is designed to be to try to find a bull market somewhere and to ride those bull market trends. But if I were short and I was shorting stocks, if I got anywhere in the extreme range, I might want to lighten up on getting into new short positions, because we're probably due for that bounce. And I don't want to short down here and then we get a bounce and now I'm going to have to stop out or get out of the trade. So this can kind of tell you these indicators here are trying to tell you where you are in the trend. Are you near these potential reversal points? Because that helps you make some decisions, whether it's to get into a trade or get out of a trade or stop out of a trade. This can help you with some of those decisions. Breadth, same thing. Now this one's down a little off the middle right here. We're still kind of in the high range. What the breadth is telling us is how many stocks are participating. Is there, are there just a few stocks that are moving the indexes, the big companies, or is every company up that day or participating in the rally? That's what this is helping us to determine here. And we're still, we're off the middle part right here, but we're not in the extreme range. So this is again indicating that we could still continue to see the market turn down. And then sentiment's been relatively high. We need to see this get a lot closer to the fear range before we'll know where we're getting close to a market bottom. So usually at a market bottom, people are very fearful or pessimistic. And this is saying that despite the market going down for so much, they just haven't gotten fearful or pessimistic. Now, I need to point this out because I've had some people comment, well, Jerry, a lot of people are bearish right now, so, usually when a lot of people are bearish, doesn't that mean that the market should start to move up, or that it's at a bottom? That is true. We do look for extremes, and we definitely want to be careful at extremes, because usually the market is wrong when it gets too far to one side. When everyone believes it's going to go up and everyone's bullish, a lot of times that's when you get these big corrections, because the crowd is too far to one side. When everyone's bearish, a lot of times you can see the market rally. The problem, though, and this is, again, through a lot of experience, going through a lot of these cycles, and I keep bringing this up, but I know there's new people that keep joining, so I want to make sure I'm not assuming everyone's been with us for a long time. But in almost every major market bottom, you're going to see some sort of a panic sell-off or a fearful sell-off where people are wondering how much lower we're going to drop. How much worse is this going to get? And we haven't seen that yet. And again, this is showing us that the complacency has remained high. Despite the whole, and those of you that have been watching this for several months, I think one of the sell-offs we had a few months ago, we barely got into the trending range. We didn't get it. We're still nowhere near any sort of fear. And to be honest with you, I don't know that at this point that I'm expecting it to get into extreme fear. But we've got to get at least into the fear category here before I'm even going to start talking about a bottom. I've talked about the VIX. If you have a chart that can show you the VIX, I need to see some sell-off. I don't care when it is, but I need to see at least some sell-off that gets the VIX above 40. 40 would be a level of the market freaking out, of panic selling taking place. We've had some moves above 30. 30 is a level of fear, and it's a level of concern. We've been above 30 a few times, but we just haven't had that panic sell-off yet. I think that's coming at some point. It's got to. Well, it doesn't have to. the market doesn't always have to do what we believe it's going to do. We can't know exactly what it's going to do. But again, we know that, and that's why we approach everything in trading in terms of probabilities. And although I can't know exactly that the market's going to go up or go down, I can know there's a high probability it's going to go up or go down, and then I'm going to manage that. I'm going to have, an entry plan, a stop loss plan, all that kind of stuff. All right. Now, buy-sell ratios, these have come closer together, and now they're starting to move outward here. So we're starting to see the sells, but not by much. I mean, they've come closer together. So this is showing you extremes as well. When you get the wide bands right here, this means the buys, stocks have moved from buy back to hold, and stocks moving from hold to sells. The sells are increasing, the buys are decreasing, but it gets to a point where these lines can get too wide apart. Now, there's not an absolute, this is not a mathematical absolute here where we're looking for an exact spot. This is just relative. This is relatively wide right here. If you see these bands stretched out like this, you're probably seeing those direction alerts being you're oversold. You're due for a rally or a bounce. These get too wide. They're too far apart. When they're closer together, it just means that you could start trending again. And again, that could be up or down. This isn't telling you what direction. You want to see what the chart is telling us. So what I'm analyzing from here then is that we're in probably a correction within the downtrend, and we're likely to continue the downtrend. We're likely to see this move back up and the buys move back down and start widening out again. Now that could that doesn't have to play out immediately. I'm going to go through, as soon as we get to the market chart here, I'm going to go through some of the different scenarios that I see that could take place. Sentiment indicators right in the middle here, so it's not in any extreme range. So all these are telling us basically the same thing. All right, let's get to the chart. And last week, we talked about we had this originally a few weeks ago. I was thinking, okay, maybe this could be a bearish ABC pattern right here, and that this was the start of a bigger move down, continuing this downtrend. We've got lower highs, lower lows. We had this little uptick last week right here, and it's like, okay, what else could this be? Well, this is a little pause right here. I don't know if this is a real clear ABC, and that's the thing, is corrective moves, they don't always, they're not going to be always perfect and easy to read and play out exactly the way that we thought they're going to play out. For example, typically an ABC pattern will just be wave A, wave B, wave C, and then you'll drop again. This will be your corrective move. But the market will throw little curves at you. It never wants. It's never going to allow you to know exactly what it's going to do. And so, it might have wave A, wave B, and then look like wave C, and then do this, and then drop down to here, and then come up to here, and then drop. Okay, something like that. Well, okay, that wasn't the textbook ABC pattern, right? But this is why when I teach ABC patterns, I teach corrective moves. When you hear me say corrective, I want you to think choppy or sideways, or sideways, kind of back and forth, kind of a pause. When I say impulsive, it means going, and it could be going up or going down, but it's go. It's like, right here we had 3 or 4 or 5 days where it just went straight down. Okay. Notice how this was more sideways, more choppy, back and forth. That's corrective. This is impulsive. Can you have impulsive up? Yeah, that was impulsive up. It went up, 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 up. Okay. So when you hear me use those words, that's what I'm saying. And that's why when I say ABC pattern, I'm not always meaning it has to have just the three moves. I'm expecting it to be more choppy, more corrective looking. And that's a correction right in through here. But notice how it could throw you off a little bit. You think, okay, here we're going to drop now, especially if it goes down a little bit lower right here. Here we're going to take off and drop, and then it goes one more curve. And you think, oh, well, maybe it's going to go up. Maybe I'm wrong. And then bam, and then you get the big move down. Now, the way you deal with that is through your trade management. You have stops in play. You might get stopped out because you thought, if I was shorting, I thought maybe you thought it was going to drop right here, and then it came right back. So you were wrong right here, but you kept your losses pretty small. Then you short again right here where you get confirmation, and then you get the big move, and that makes up for the other smaller losses. So this is why it's impossible to always be right. You're not always going to make money. And if you have that belief that boy, if I just take this training program or if I just follow this guru, I'm never going to be wrong, because I hate being wrong. Everybody hates being wrong. Nobody wants to be wrong. But you're going to be wrong a lot. And so you have to learn to embrace it. You have to learn to embrace the failure. You know what? I believe that every trader, I believe that every kid should grow up playing baseball in order to be a great trader. Because if you know baseball is a game of failure. You fail and fail and fail and fail everywhere. Pitchers are always failing. Hitters are always the best hitters in baseball are a 300 hitter. That means they fail 70% of the time, and yet they're the best. They're the best at the game. So the reason why I always say that baseball players make great traders is because they're already used to that. They know they can't get a hit every time. And so when they get out, they don't look at that as devastating. They look at that as, okay, I'll make an adjustment, or maybe I didn't get the right pitch to hit, but I know I'm going to get my hits. I know that at the end of the season, I'm going to be a 300 hitter. I don't know. I could have streaks of where I'm hitting, everything in sight. And I could have streaks during the season where I can't seem to see the ball at all. And that's the mentality you have to have in trading is, I know I'm going to make money, but it could be easy. Oh, that was a clear textbook ABC pattern, and I timed it right, and it immediately went in the direction I thought it was going to go. Or it could whipsaw you a little bit. You have a couple losing trades in here, and then you get the big move. But you lost some money here, small amounts of money, because you kept your risk small, but then you caught the big move right there. Sorry, I'm probably getting off on some tangents here, but they're important lessons to learn. All right, so when we start to rally up right here, I'm saying, okay, we're not probably in an impulsive move down there. This is going to go whoosh down like this. What else could be going on? And my first thought, and this is what I talked about last week, was, okay, maybe this move wasn't the correction. Maybe that was just wave A. And maybe this move down right here was just wave B. And then we're going to move up into here for wave C, and then we're going to drop. Okay. And that still could be possible. This little downturn right here, if this is just a little bit of a pullback right here, it could be just correcting this little move up right here, little small corrections, small correction right here. That CPI report could be looked at as being positive for the market, and maybe it rallies up. Even if it's positive, by the way, I think that the market could rally, but it'll be probably short-lived. You'd be looking for some sort of bearish reversal if you were shorting, that you want to jump in and short, or you're looking to buy. There's just not a lot of stuff to buy right now. We're still kind of in that waiting mode for the market to bottom. But so that could be something that takes place. Another possibility here is, well, it's possible that this could be complete. Wave A, wave B, wave C. And we're going to drop straight down here. Now, the problem with that is typically wave C is going to go beyond the end of wave A. So if I draw this out, that's wave A, wave B, then wave C will typically go at least a little bit beyond the end of wave. It doesn't need to go that much beyond it. Most of the time it will. And when Very rarely does it go right to the end of wave A and then drop, but it does do it sometimes. So you have to be aware that it's possible. It's just usually not very probable. Okay. But another pattern I've been looking at is that it could be that, because what happens a lot of times in ABC patterns is you get wave A and wave C tend to be smaller impulsive moves. They tend to be a little bit sharper. Wave Bs tend to be corrective. So this could be wave A where it moves down sharply, and then wave B could have an kind of an ABC pattern within an opposite ABC pattern within that wave B, and then you get wave C. So this is a corrective move. This is a correction of this trend, but within that correction, you can get this smaller impulsive move down, smaller corrective move up, smaller impulsive move down. Now we're looking at bearish, so I probably should have drawn this as a bearish ABC. So if we have a downtrending move, a sharp move up could be wave A, and then on the wave B, it could be an opposite ABC pattern, in this case, kind of a bullish ABC pattern for wave B, and then you get wave C, and then you get the next drop down. So this would be wave A. This would be the first move of wave B, second move of wave B, and maybe we drop down into here, and that's wave B, and then we move up for wave C, and then we drop. Now this is key right here, because all of this can't exceed that high, because this was the last impulsive move down. That went to the lower low. This was the lower high. You can't, if you go above there, now you've gone to a higher high. Now you're talking about potential trend reversal at that point. Maybe you're reversing back into an uptrend, because it may be starting to act like an uptrend. But this is something I'm also looking at as a possibility. And what this could mean is that maybe we get an initial reaction to the CPI report where we drop, but we don't drop that far. And then we start rallying back up. Now this is an interesting hypothesis here, because this is how I could see the because I always look for how the market is. Traders are it becomes pretty sadistic. I used to say that the market is always finding a way to hurt the most people possible, and it's true. The market and when we say the market, it's like this. It makes it sound like this big giant monster, right? It can be sometimes, I guess, if you don't know what you're doing. But the market is, and this gets back to what I was talking about earlier. If everyone's bullish, then the market is going to find a way to break those bulls. It's going to find a way to fool those bullish people and hurt them. And so because I understand that, and by the way, the market is all of us. But it's other traders out there, very powerful traders, that know all this, and they know the human nature, and they know when everyone's bullish, man, if I could scare them into selling, I can make a lot of money. And there's things, tricks they use and things they do to move the markets in those directions and cause those things to happen. There's a lot of dynamics here I could get into. If you study some Elliott wave analysis, I've got some Elliott wave training on the YouTube channel there. You learn a little bit about human nature and human nature as it relates to trading. I think that's important stuff. Not that you're going to base your trade on that, but it's important to understand, because you understand how the market works. So again, what I'm trying to look at here, when I'm looking at different scenarios here, is, okay, how could I see the market dropping in a sharp way? Well, in order to see the market drop, and this is what's been troubling me recently, is because there are a lot of people that are bearish, it's hard to get a panic sell-off when people are already bearish. What has to usually happen is there's got to be some sort of hope that starts to come in that this is it, this is done, and then it gets ripped away from you, and that's what can create that panic. So I'm looking at this saying, okay, maybe that CPI report is bearish. We drop down initially, so everyone thinks, oh yeah, we're back to going lower again. Then we stop. By the way, these things don't always play out the way I go over them in the classes. For those that are new, I'm not trying to predict anything. What I'm trying to do is go over different scenarios that I could see happening based on chart patterns, so that if it starts to unfold that way, I'm already prepared. I've already analyzed it. It's kind of like setting up a game plan for a football game. You don't just go in and play defense and hope you can defend the other team. No, you study their plays. You study their formations. You study their tendencies. What do they like to do on first down or second down? So that you're not going to know exactly what play they're going to run, but you're prepared if they do start to run a play that you recognize. You've done all that work. So you're not caught off guard. That's what we're trying to do right here, is just kind of game plan for the next couple of days what might play out so that we're not caught off guard. So this could start to say, those are the bears, okay, we're going down. This is what we thought. And then suddenly we start rallying, and we might rally for a few days. And then everyone might be starting to say, hey, maybe we're done. Maybe, and there could be, reasons for it. I don't know what the reasons might be, but there could be some economic number that's getting people really bullish, or some Fed president or some Fed leader would make a comment that was dovish or something like that caused the market to rally. And then when they're turning more bullish right here, then it rolls over and you get the sharp move down. Well, look at this right here. Look at this. So you had this big move down. You had, because I got caught up in this. This one caught me off guard. You had this big, or this sharp up day right here. Looked like we could rally up a little bit. Then you had this immediate down day, and not only was it a down day, but it went lower. So you broke to a lower low right here, which usually doesn't happen within the correction. Usually in the correction, you hit the low, you get wave A, wave B doesn't go below here. It may come all the way back to it, but it usually doesn't go to a lower low. Here it did. It went slightly lower low, so it looked like I was convinced we're dropping right here. And then you get a bullish reversal candle and this big bullish candle right here. I remember it was playing. I know this because it was playing with my emotions. Again, we're looking back in hindsight, but at the time, I don't know what's going to happen. I don't know what's going to go on, what's going on. I'm thinking, okay, maybe we're going up a little bit higher. This still looked corrected to me back and forth, but I thought maybe we're going to go up a little bit higher and come up to this little support level and then roll over. The very next day, we had a bearish reversal candle right there, and then, damn, we went to that impulsive move. If some of you remember this, back here, one of the phrases I teach you all the time is whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. But again, it's not absolute. It doesn't mean it has to. It doesn't mean it will. Just the majority of the time, probably about 90% of the time, if I want to throw that out there as an example, maybe not exactly 90%, but most of the time it's going to move in the direction it was moving in before it moved sideways. Well, back here, we had this sharp move up. We had this sideways move right here. And you remember I was saying there's a very high probability we're going to go higher. At least, it doesn't have to go very much higher, but you should have at least a breakout of the sideways range, some sort of breakout, and then it can reverse and go down. But we didn't even get that. It dropped straight down for this fooled me. This fooled me. This fooled me. And I've been doing this for 20 years. So the market can fool us. But that's why that's why you don't see me say this is going to happen. Well, I kind of did that here with a 90% probability, but we don't focus on absolutes. We're not going to, and by the way, I lost a little money on some long positions I had, but I did some put option trades after this day right here when it looked like we were really dropping. I made up some money on that rest of that drop. So now I don't teach options in this class, but that's how I prefer to trade. I can trade both directions, but I don't like to short stocks. And so if you learn about put options, how they work, and you can do that. That's what I did there. Is I just traded that little move down. So, all right, so that's what I'll be looking at. Now, obviously, like I said before, it could be that this is still wave A, wave B. So if tomorrow, and then we're in wave C. So if tomorrow the CPI report comes out and this this breaks out above this high right back here, we just start moving up. We don't even need to break out on that day, but we just start moving up over the next few days, the rest of this week. Then that's probably what I would look at, is that this is probably wave A, wave B, wave C, and then we'll be looking for it to roll over. Now, where might we look to see it roll over? Well, we've got, you'll notice right here, there's a lot of support resistance here. Support back here, support right here, resistance here, resistance here. Then there's another area that's right in here. Actually, where there's a small area right, yeah, kind of right in here. That's where it gapped down. That's hard because there's not a lot of exactness around here. There's a low right there. This kind of moved up above it. A little bit of congestion. By the way, with some of these support and resistance areas, I'm not looking for exactness. I'm looking for kind of a zone or an area. So that might be an area where I think maybe it could rally up to and then roll over. If it did rally up to that area there, another thing that you look at with ABC patterns is very often the ABC pattern is complete when wave A and wave C are about the same length. So that would make maybe wave C a little bit longer than wave A in that area right here, but that'd definitely be a target area where I might expect it to roll over. If it's going to roll over, maybe it breaks through that. If it starts breaking through that, we're breaking above these levels, then that's when you have to start turning more bullish. And sometimes I have to force myself to turn more bullish. It's like, well, and we break out above here, I might still try to hang on to the fact, and it could still possibly roll over and go down. We can't know exactly, but that would be, we've had lower highs, lower lows. That would be a higher high after a lower low. So we had a lower low here. We move up above here. That'd be a higher high after a lower low. That's an early signal of a trend reversal. Could be starting to move into an uptrend at that point. But because we're trending down and we're trend traders, we're assuming that we're going to continue to move down until, like I said, until we see something change. There's a question here. Given that there really isn't much to buy right now, how do you explain all the stocks in the software with buy signals? The buy signals are generated by an algorithm. Okay, all they're looking at is the algorithm, and if a stock has a buy signal, it means it is outperforming. And there are stocks in uptrends. Okay, there are, but now I've explained this before, but it's worth bringing up again because obviously I have new people that come around. What are your best chances of making money on a stock going up? Let me give you two scenarios, and I'll just keep it simple. We'll say 500 stocks. Out of 500 stocks, 450 of them are trending down. 50 of them, well, you got to have some that are just moving sideways. So we'll just say 25 of them are trending up, and we'll say another 25 are just kind of moving sideways. These stocks and uptrends, they've got buy signals. What are my chances of getting into one of these stocks and having one of those stocks go higher, continue to go higher and continue to perform very strong, okay, versus we've got 500 stocks 450 of them are moving up, 50 of them are going down, or 25 are going down, and 25 are moving sideways. You can always find a stock that's going in an uptrend versus the market. But the question is, should I be in that stock? Or more importantly, is my probability of making money the greatest being in that stock? It probably is, from the standpoint, you can make the argument saying, well, it is trending up. Okay, that's what it is doing. I'm not saying you couldn't trade it. I'm not saying you shouldn't trade it. If you have a plan, you can always. By the way, again, don't get me wrong. I'm saying that if you can find these, well, that's what we're trying to do, is find these stocks that are these 25 that are trending up when everything's trending down. We did that. Remember, oil was the only one going up at the time a few weeks ago, and the Fed stocks, and we were in those, and that's all we were in, and they worked out for us. But we also had plans in place when they broke, when oil started to roll over. Notice what I did. I got out of oil. But what else did I do during that whole period of time? I didn't have all my money in oil. I didn't have every bit of my portfolio in the market. Why? Because momentum wasn't in my favor. The majority of stocks are going down. So I guess that, to answer your question, there's a difference between a trade or a portfolio, right? I can make a trade or two, but I don't want to be all in. I don't want to be all in long in a bear market, because I'm trying to swim upstream. Can I swim upstream? Yeah, but it's going to be hard. I'm not going to move very far. And then once I'm out of strength and tired, I'm going to get swept right back downstream. I'm going to eliminate all the work I did. And the problem sometimes with some of these stocks that are trending up during a down market is, as soon as they turn around, which, because they're not going to go up forever, they can drop very sharply because sellers are dominating the market. They're the ones in control. So this is the purpose of the class, is to say there isn't just one. It's just not the buy signal, sell signal that we're looking for. This is what the purpose of the market update. We want to know where we're trending, where we are within the trend. Are we overbought, oversold? You can look under the indexes right here. You can see that there's far more sells right now than buys. So that's telling you that that things are weaker, that the trend is down. I go over in that, one of the things I tell you that's real simple is, the system of looking for a stock that's a 98 strength rank going from hold to buy. It works best when the buy-sell ratios of the entire market are above 1 as a minimum. Obviously, if they're up a lot higher than that, there's now momentum. It's telling you momentum is moving to the buy side, and it doesn't mean you load up again in your portfolio in that situation, but you can start to add more. Usually when it's below 1, you really don't want to do anything, and we're below. We got close here a few days ago, up there to 0.86, but now we're back down to 0.56. And I'll give you even a better example. What did I get? What did I do? What stock did I get in the portfolio? I got this RCMT last time. And remember, my reason was big long uptrend. It's been outperforming when the market has been dropping. It looks like it's gone through a corrective phase, ABC. Had a bullish candle. I can't remember which day it was I got in, but it had a bullish. Looked like it was starting to move back up off of that. The plan was to get in case this was the end of the correction. It's going to move up. If all it did was move up to this previous high, I'm going to make this much money, which is very good. I have my stop right below this low right here. If I get stopped out, I'll lose money, but I won't lose as much as I have potentially to make if it takes off. What did it do? It came right back down, and I'm probably going to get stopped out. That doesn't surprise me because momentum in the market right now is to the downside. You're going to get a lot of these that look like they could go up and they don't. Now, you could make the argument, well, Jerry, you didn't wait for the buy signal. You were a little bit more aggressive. And that's a good argument. I could, and I always point that out. I think I did point that out here. As you said, you could wait for it to go back to a buy signal first. I just had a little bit more aggressive approach because I had a clear plan and it was all based on reward to risk. If we move up from here, and remember last week too, we were looking at the S&P chart. And I got to also emphasize, I'm assuming everyone in this class is here to learn more about trading. And the more you know about trading, and then you incorporate the signals and the trend analysis software, you're going to get better results because you're putting the time in to become a well-rounded trader. You're learning about I'm assuming that you don't want to learn to trade and you just want a simple approach. Just give me the signal of when to get in to find good stocks. The software can do that too. So again, just be aware of that I'm not trying to say that this can't be a simple approach. It's very simple when you get great results when you know when you're a trained trader as well. If you're a trained trader and you're using the software, it's really easy, and you get really great results because you know what you're looking at, you know what you're seeing, you know which trends, which buy signals are in stronger looking trends than others. All right, so the S&P, I was going to show you on the S&P chart. Remember last week it was looking like we were starting to move up right here. It was looking like we could come up right up into here. This could be wave A, wave B, wave C. So I thought if it does that, or if it keeps going up and starts breaking out above there, that stock would continue to move up and I could profit from it. And it still could. It hasn't stopped me out yet. But it's getting pretty close. And to be honest, if you have a bullish reversal candle and you start to move up and you're almost down to the lower part of that bullish reversal candle, that's not likely to hold. That's probably, I'm going to get stopped out of this thing. Maybe not immediately. Maybe it has another attempted move up, but this is probably going to get stopped out. That's fine. I'm going to show you, I'll show you, I got to go through the rest of the charts, but I'll show you what I'm going to do in the portfolio to hedge against it if I get stopped out and make some of that loss back. All right. So let's go back to, obviously the other market charts are going to be about the same, the Dow, the NASDAQ 100. I know I keep skipping through these, but they will become relevant again where I'll focus just on the NASDAQ or just on the Russell. If they're all telling me basically the same thing or could do the same thing, then I'll do the S&P and then I'll skip over those. So I've skipped over them a lot, mostly because they've all been kind of moving in the same direction and doing the same thing or telling us the same thing. But if I start seeing small caps outperforming the Dow stocks, then that could be a signal that the market is becoming more bullish, and I'll be focusing mostly on the Russell in that update when that happens. Bonds, we've been watching bonds quite a bit, and the expectation here was that this is a bearish ABC pattern on bonds, and that we are starting another move down, lower highs, lower lows. And then we had the little rally in bonds. Although today that's a bearish reversal candle. We opened higher. It's showing the bonds are up. Here's where we closed yesterday. We opened right here. We ran all the way up here today. Now we're trading lower than where we opened. The buyers have been very weak. So although it's going to say that CLT is up, the bonds are up, because we are up from where we were yesterday, this is a subtle momentum change that if you know how to read it, you can take advantage of it. That is a weak candle. There's a very, very good chance that bonds are going to go down tomorrow. And again, this is very short term. So it's not saying that we're going to resume this downtrend. It's just saying they should be down tomorrow. Maybe it goes down right here and then goes right back up again. That could happen. But this is a little bit of a bearish reversal there. So it could be that this was just the start of the move down, had a little bit of a bounce, and then maybe it continues to move lower. That CPI report will have a big impact on the bond market too. So in the bond yields, if yields start to rise again, then you'll see the bonds drop, the bond market drop again. Now, what's going to be the key area? Well, this is a key area right here, but not the key area. This is going to be the key area back here. Why? You always focus on, when you're talking about lower highs, lower lows, it's the if you're looking for a trend reversal, you're looking at the previous lower high after the recent lower, or before the recent lower low. So this went to a lower low right here. We're going up. This was the last lower high before we went to that lower low. Does that make sense? The reason why that's important is, remember I said these corrective moves can fool you a little bit. This could look like the start of the move down. This could still move back up, and it could even go above here, but this could still be that choppy correction. See, that's what happened back here. So we had this little bounce, and we went to a lower low right here. Market went up, it came back down, and it actually went above this high right here. That wasn't the lower high, because that wasn't the previous lower high after the recent lower low. And it went up a little bit, but it knows. So this was the key area right here. It never went above that and then dropped. So that's what we'll be looking for. And we'll probably have more detail now on Tuesday or Thursday, when it'll be after the CPI comes out. Gold continues to go lower, it's trending lower. Now, again, it's at the far left side of this extreme reversal risk right here. What does that mean? Well, it means I don't want to go short gold right here. It's downtrend. It's been moving down a little bit, but now it's oversold. It's in an area where it's probably due to bounce, rally a little bit, or move sideways. So it's either going to go into like a bearish ABC pattern, rally up a little bit, and then drop again, or it's going to move sideways and then drop, or maybe that's the bottom, and it's going to have an impulsive move up and reverse trend, start trending up. Either way, it could. It's not as likely to keep going down, or if it does, it's just risky to get into a bearish trade on gold right here. It's just a bad entry point for a bearish trade. If you're in gold, it doesn't mean you get out. It just means you start looking for some sort of bullish reversal to decide to get out, because you're in that extreme range. Oil, see, this is a reason why I didn't get into oil trades. That we talked about this being a possible bullish ABC pattern. We had the nice strong move up a little bit right there, but I wanted to see a little bit more confirmation. I wanted to go up a little bit further. was kind of looking at it getting back above this resistance area right here. And big reversal today, big move down today. And again, here was a bullish reversal candle. And now here's the low of that. We're almost there. This thing, oil is going to go lower. At least from a probability standpoint, at least in the near term, it's likely to go lower. So I really don't want to be jumping back into oil stocks. The dollar keeps going up. It's moving higher. Clear uptrend right there. A little bit of a pause today, but we saw that happen last week where it paused a little bit for a few days and went higher. However, this is the opposite. We're in an extreme, getting into an extreme overbought area. Now it could become even more extreme. It could go up even higher here before we really are looking at a possible correction or pullback. And again, what this means is that we're in a spot here where we could either pull back, have a bullish ABC pattern, and then it could continue to trend up, or it moves sideways. The sideways movement for a period of time can alleviate an overbought condition, or it reverses trend. You get a sharp move down, and then it's actually trending down at that point. I don't see any of that yet, but it is in a spot right here where it could go into a correction or pull back. And then we'll see how it looks when it does that to see if it's acting like a trend reversal. But I don't see anything to break that trend right now, either from a technical standpoint or even a fundamental standpoint. The VIX is just basically been flat. Again, I think it's just waiting for that CPI report. It'll be interesting to see how it moves right at the very end of the trading day, because that report comes out tomorrow morning. So if traders become concerned about it and they're buying some protection ahead of it, you might see the VIX spike up a little bit or move up a little bit. But where it is right now, and with the way it's behaving today, it's telling me that traders are complacent about the report tomorrow. They're not too worried about it. Now you can make the argument that's a sign of them getting surprised. Then it could be really bad, and then they weren't protected, and the market starts selling off, and that could trigger panic. But we'll see. I don't see anything. Again, really, the VIX is not telling me anything right now by itself, or where it is right now as to what might happen tomorrow. Chip stocks have been pretty strong, and this would be a good bullish argument. Remember, chips tend to be a leading indicator. This will be something to watch tomorrow when that CPI comes out, is how do the chip stocks behave. If they start selling off big, then it probably means the market's going to sell off big. Kind of the same thing here, where this could be wave A, maybe it dips down for wave B and then wave C and then rolls over, or maybe it goes right up. This could be a wave B right here, and maybe it goes right up tomorrow. This is going to be key right in here. There's a lot of support resistance right there. You wouldn't want to break above that if you're bearish on chip stocks. You wouldn't want to break above that, but it could move up close to it and then roll over. But that's going to be a key spot on the SMH to watch right there. Well, actually, there's a couple right here that you can watch. So anything above here would be bullish for chips. There's some support right in here, and obviously any move down tomorrow would be bearish. There's next support is down here. So if we get it below here tomorrow, this is the next spot to look at as a stopping point, potential stopping point. If it's going to stop, may break through it. So bearish below here, bullish above here. And you can kind of watch that when the news comes out tomorrow. Transports, this is kind of showing the same thing, not much to add there. Bitcoin, this looks very much like this, and I think the next result is going to be the same, where it'll break this support at some point. It could rally back up and still stay sideways, but at some point it should break and go lower. All right. So in the portfolio, we already looked at RCMT. Now I could just, well, I'm going to wait to see if I get stopped out of it, but it's losing a little bit of money. I purchased it at 20. I've lost about $2 on it. Now, I went into the trade willing to risk that amount. But could I hedge it a little bit? Now a lot of this is going to depend if the market drops tomorrow, and it might not. Like I said, I went through those different scenarios with you. But if you look at, one of the things we've used to hedge is the SARK. I told you chip stocks are looking too iffy. I don't know if I want to use the SOXS, but I do like, if you look at this, again, this is an inverse ETF. So and this is based, again, I'm doing this for people that are new. This is based off of the ARK Innovation Fund, ARKK, which is it's in a lot of speculative stocks. And right now the market doesn't like speculative stocks. So when the market starts selling out, these stocks are likely to continue to get hammered. Now there's two ways you could look at this. Here's a move down. This could be a sideways move. And again, whenever you see the market moving sideways, you want to pay attention to the direction it was moving before it went sideways. That's where it's more likely to go after it started moving sideways. That is a little bit of my view as of right now. But in downtrends that start to move sideways like this, it could be a basing. This could be basing where it's moving sideways and then it's going to start to move up. You can see a little bit of a higher low right here. It would need to kind of break out of this range and do it soon to give another higher low and then some higher highs. It could start acting like an uptrend, and you might be dealing with a basing formation. So I got to be aware of that. So the SARK is going to do the opposite. If this one goes up, it's going to go down. If this one goes down, it's going to go up. So this allows me to not have to short the market. I can still be long. I can buy the SARK, and as the market drops, as these stocks drop lower, usually they're going to drop lower when the market drops lower. So this is usually what I'll do when I think the market could drop, is I'll buy this so that I'm making money when the market goes down. I'm having this trend up or go up when the market goes down. So I'm going to go ahead and take, now again, with this one, I'm not basing these trades on signals. I'm basing them on chart patterns and my expectation of the indexes. I'm only using them to hedge, and they're very short term. I can jump in and out of them how I like. And again, I'm not suggesting that you have to do this. The other choice is just to wait to see if I get stopped out, or to stay out of the market, stay in cash. But the reason why I'm teaching this is because we could have a lot of boring classes where we're still in cash, we're in a bear market, we shouldn't be in a lot of stocks right now, so we're still in cash, and I'm going to lose you. You're going to be like, why am I going to this? Why am I spending an hour of my time with this guy who's not giving me any valuable information? So what I'm trying to do is say, hey, if you're stuck in a bear market, obviously you're not going to make a lot of money in a bear market when you're mostly a long trader, meaning you want to buy stocks, you want stocks to go up in value. And you can lose a lot of money in bear markets. People lose, big fund managers have been doing this for 40 years, lose a lot of money in bear markets. How can you do something to either prevent you from losing money or even make you money? We were down, before I started doing the hedging thing with this, we were down around 100,000 on the portfolio. We're at 120, so we made $20,000 while the market went down, and we had very little long positions, and most of that was through doing this hedging. And now you have to be able to recognize when the markets look like they're going to go down. The chart looks like it's going to go down, but that's why I spent all this time teaching you so that you can learn to recognize some of those how to recognize a bearish trend, not look at everything as being bullish. When you have a bullish bias, then, you're in this downtrend and you're looking at every reason why the market's going to go up, or, it has an upward move and you're like, okay, that's it. This is going to take off now. It's gone down too far. It's going to start going up, and it goes down again. And so you're all, and that's why I look at different pros and cons. I just spent all that time on the S&P. This could happen. It could go up, it could go down. If it goes down, this is where I expect it to go down to. If it goes up, this is where I expect it to go up to. And a lot of that is to also force myself not to only look at things from to get a bias and where I can't see the obvious clues that are telling me I'm wrong, because I'm so focused on trying to find reasons why I'm right. And that's human nature. We all do that. We have to fight that. So I'm going to go ahead and on this one here. So this is, we had a nice this looks like a correction of this move up right here. And I had a nice big bullish candle yesterday, and then it's a little bit of an indecision candle today. And we would expect that. We got this binary event tomorrow. I'm going to stop out if it goes below here. I'm going to see if this thing starts moving up, if the market moves up. And if the market suddenly goes up tomorrow, that RCMT could just turn around and go up. So I could be making money on that, even if I'm losing money on this, and then I could just jump out of this real quick if it doesn't look like or if it goes down. This goes down, doesn't look like the market's dropping. I can jump out of this and then maybe we start adding long positions if the market starts looking more bullish. Maybe Thursday we're going to finally have some new positions to get into. We'll see. All right, so I'm going to add this to the portfolio. I'm going to put my stop below that low, which was at 52.50. How much would 100 shares be? 100 is 5,000, so it'd be about 180. About 170. Okay, we'll do 170 shares. I usually like to keep the transaction cost between that 7,000 to 10,000 range. We'll go just under 10 there. And then I want my portfolio at risk to be I don't want it not to be higher than 1.5% of the total portfolio. Usually that's around $1,500. In this case, it's only about $700. That's about how much I would lose if I get stopped out, approximately. I don't know what price I'm going to get stopped out at, so I don't know the exact amount. But this all fits within what I like to look for, so I'm going to go ahead and purchase. And I got to wrap things up, but let's do one stock real quick that was a pattern I liked under consumer staples, under the hold section right here. And I went through a lot of these sectors. I don't see a lot of patterns I like. And that's why when that happens, it's telling you this is not a great time to be jumping into a lot of stuff. So I'm not getting into this, but this is a bullish looking pattern here. If someone's looking for some sort of bullish looking pattern, it's been outperforming. You got a nice strong uptrend here. It's pulled back a little bit right here. It's gone to a hold signal. You could wait for it to go back to a buy signal as confirmation, because maybe it does pull back a little bit deeper before going up again. Or this is not acting like a trend reversal, because that would be a little bit more impulsive down. It's not. It's looking choppy. But this is one that's outperforming, and if it goes back to a buy signal, could continue to move higher. So I'll throw that one out there to at least have one stock. So I know there's always somebody the reason why they're sitting through this hour is they're looking for a trade idea, and that could be a potential trade idea. All right, thanks everyone. Have a great week. We'll see you Thursday for the stock specific class, and hopefully there's some stocks to get into. If not, I'll see if I got some other material I can talk about that'll make it worth your time. All right. Have a great week, everyone. See you on Thursday. Bye now.